And now we start with the first session for the day. The topic of our session is Impact Investing in a Turbulent Market. The speaker for the session is Mr. Hector Gomez, ANG, Regional Director, South Asia, International Finance Corporation. To begin with, I would like to invite the moderator for the session, Ms. Ashu Suyesh. I'd like to introduce Ms. Ashu Suyesh to all of you. Ashu Suyesh is a successful leader with over 33 years of experience in the Indian financial services and the global information services sector. She was the Managing Director and CEO of CRISIL Limited up until 30th September 2021. Currently, she is in the process of setting up her own venture and is an independent director on the board of Hindustan Unilever Limited. Prior to joining CRISIL, she has held several senior roles spanning across banking, capital markets, asset management, ratings, research, and analytics. Over the years, Ashu has received several awards and has been recognized amongst the top 50 women in business in India and Asia. Ashu is a chartered accountant and holds a bachelor's degree in commerce from University of Mumbai. Ms. Ashu Suyesh, the floor is yours now.
Thank you very much, Monica. I want to thank the CFA Institute for inviting me to this great conference with excellent topics and very, very relevant and topical as well. And definitely this particular session on impact investing is very close to my heart. It's something that I have followed over the years, and I really believe is one of the most relevant ways of making our planet a better place without at all compromising on returns in any way. When I think about the way impact investing has grown in India, the numbers by themselves tell the story. In 2010, if I remember, the size of the impact investing industry was all of $323 million. And 2020, is the year of the pandemic, and we continue to be there. We closed at 2.6 billion. It was about 20% lower than 2019, which I think was the record year for the industry, for the impact investing industry in India, with flows, with new capital invested of $3.5 billion. What's interesting is that in 2021, the numbers seem to be back up. And based on some reports that I'd seen, I think $2.3 billion has already been invested from January to August of 2021. What I find is that the top three sectors from an allocation point of view have largely remained unchanged through, let's say, 2015 through 2020, which is on financial access, education, and agriculture. I was a little surprised not to see as much allocated to healthcare in 2020. But in 2021, we started seeing the change with a lot more allocated to the healthcare sector. And it is no surprise because while 2020 was the start of the pandemic, I think 2021 really challenged everybody. And when I talk about India, the second wave was really, devastating in a lot of ways. At the same time, I think the whole world has started coping with the pandemic in a much better way across policymakers, investors, companies. And that really makes the topic for this session very relevant. It's about impact investing in a turbulent time. And who better to talk about it than Hector Gomez representing IFC, especially given IFC's long association with India and how they contribute in a lot of ways to India's development. I'd like to welcome and introduce our speaker for the session, Hector Gomez. He is IFC's Regional Director for South Asia. Prior to his role, his current role, he was IFC's Regional Manager for Angola, Mozambique, Zambia, and Botswana. And between 2014 and 2019, he was IFC's Country Manager for Brazil. He joined IFC in Mexico in 2007. In his role as Regional Director for South Asia, he will focus on strengthening IFC's franchise in South Asia and will target diversified growth across their portfolio and will leverage all of IFC's products. Prior to joining IFC, Hector was the Director of M&A and Business Development for AIG Consumer Finance. And before that, a member of Citigroup's Emerging Market Strategy Unit in New York. In fact, he started his career in banking with Citigroup's investment banking team in Sao Paulo. And he also has prior experience of working in an oil field as an engineer with Schlumberger. Hector holds an MBA, Chemical and Systems Engineering degrees from Tecnológico de Montero in Mexico, and an MSc in Social Business and Entrepreneurship from London School of Economics. So without further ado, would like to invite Hector to share his thoughts on impact investing in turbulent times. Over to you, Hector.
Thank you. Thanks, Ashu, and thanks for the CFI Society and the CFA Institute for the invitation. And you know, this is just a little bit of background. This is an evolving field, and it's a very interesting one, as you mentioned. 2013, 14, when we were looking at the first impact fund in Brazil, we internally at IFC were faced with a dilemma, which was, what is this impact investment that is different than what we're doing, right? So it's here we are talking, 8 years later, but it was sort of a voyage of discovery for us. I have some slides that I would like to use and essentially give you a sense of where we are in terms of impact investment and what's working. And maybe for that, what I would suggest, what I would start with is with maybe tell you a little bit about IFC and why is it that we are here, that it makes sense. Who we are part of the World Bank. The World Bank Group as a whole, and the World Bank, as you know, works with the public sector. IFC, we work with the private sector. We are the largest private sector focused global development bank. We essentially are a AAA rated entity that we do equity, we do finance, we do mezzanine, we do any type of product to support private sector companies. Okay. We also provide advice in specific areas, and we also are engaged in a lot of our work means investing our money and mobilizing other people's money. Okay? So we try to bring a full package. If you look at our portfolio globally, and because we're in the concept of impact investment, and we see essentially 100% of our portfolio as an impact portfolio, it's more or less, it's 20% infrastructure, 42% around financial markets, around, another, let's say 35% manufacturing and services as a whole, and telecom, media technology would be around 3-4%. Okay, so it's with essentially technology being probably the highest growth, of course, from a slow base. We invest around $22 billion per year. That's sort of the number, the headline number. Let me move on to. Sorry. Okay. What you mentioned here, we have a long association with India. India is our largest market in the world. It's our largest business in globally. We have, over the past 10 years, invested around $15 billion in India. We've been facing, headwinds in terms of, you look at the volume, but I think we're very, very, not only proud, but very, very focused on that. What happens inside, we shouldn't be looking at the total volume invested. We're looking at the impact that that volume has, and I think we are actually on an upward trend in that sense, right? We have built our whole Asia sort of digital investment strategies, essentially based out of India, and it's one of the success stories together with the renewables. India is also one of the largest shareholders of IFC, so that's a relevant fact. And here in India, we have a much more diversified, again, some sort of portfolio across sectors, right? So the largest sector would be NBFIs and microfinance with 20%, and then renewables is the next one with 70%. So this is the snapshot of where we are and what we see our portfolio essentially 100% impact. Okay? And maybe to get here, what is impact investment, right? I think it's relevant to say this because there are many definitions, and I don't think, yes, I want to, as a preview, we're not going to get with a specific definition out of this, but I want to give you a little bit of the journey that the industry has had. There are different but related definitions, so I don't want to read, but essentially you look at some of the three most quoted definitions, and one says impact investments are investments made with the intention to generate positive and measurable social and environmental impact, right? You see another one, and it's investments with the dual mandate of financial return and positive impact in society. You see another one, it's impact investment is an approach, right? So we're getting there. The operating principles for impact management is an IFC initiative, led initiative, but together with a group of 54 partners. So there are these different, but I think you start to get the sense of what we mean. We're trying to achieve two things at the same time. We're trying to achieve returns, and we're trying to achieve social and environmental impact, right? How we get there, it could be different, and within that spectrum, there are many definitions. I think one key aspect of impact investment is the intentionality of the impact, right? So it's not you're having impact as a trickle down. It's not because, okay, I'm investing in a given company, and hence, at the end of the day, there will be salaries, and then that's good for the employees of that company. That's sort of a trickle down, and but the intentionality to have the impact is what I think it makes a difference, and what has been evolving over the past years. So maybe just spending a couple of minutes here, the traditional philanthropy. So I want to help a cause. I'm not seeking returns. I'm just seeking the impact. I'm seeking, to improve some specific group's lives or livelihood. That's a traditional philanthropy, right? Then you have venture philanthropy. And you start maybe supporting some sorts of businesses that help address this. Then you have the impact investing that here is called concessionary, and this is from Professor Singh from INSEAD, which I think it's one of the most, at least has helped me explain better what impact investing is. Impact investment on a concessionary basis. So you're not seeking full on market returns. And then I think what we're talking about here is impact investment on a non-concessionary basis. An impact investment on a non-concessionary basis, which is this piece, it's at par in terms of the search for returns with the traditional investing and with sustainable, responsible investing. So what we're looking for here is we want to get the same returns, but we want to get much more impact. And we have the intention to have this impact. And I think this is a big change. How you achieve this impact, you could have different vehicles, right? You could have the traditional businesses. You could have a business that has defined itself to be sustainable. You could have an impact business. You could have a social enterprise, or you could have a pure NGO, right? The way you achieve it and the vehicles that you use by investing in any of these types of vehicles, it's different. You would see that the non-concessionary investing that we are discussing here most likely is going to be, but not necessarily only, it's going to be through impact investments, businesses that are self-defined and sustainable, and traditional businesses. That does not mean that it's not going to be achieved through social enterprises. I think actually it's an emerging field where social enterprises that can manage to deliver the two are delivering more and better market level returns. Okay, and maybe a way to define this is essentially what we're looking for. It's we're trying to maximize, to push the curve so that we can, instead of doing one or the other, the financial outcome or the social outcome or the social and environmental outcome, we try to, with impact investing, we're trying to push this curve up so that we can achieve both through a single vehicle or a single investment, right? This is, of course, aspirational and it's a trial and error, but I would say that if we could potentially chart all the graphs as how we're developing impact investment, this is actually moving up towards that efficiency frontier, if you wanna call it. Maybe to wrap up as to what is impact investment, let me tell you how we see it. Okay, so the way we see it is, rather than define it in terms of it's an impact investment that you do through A, B, or C, we see 3 observable attributes in impact investors, right? So it's really more of an approach. The first one is impact investors have an intent to achieve social or environmental goals through their investments. There is a credible narrative by which their investment contributes to the achievement of those goals. Okay, so there is a narrative. There is what you would call a theory of change. You say, if I do these types of investments, and these investments manage to create certain conditions, then the impact expected is A, B, or C, right? I think there has to be a narrative. And then I think the most important one, or not the most important, very relevant one today is you need to have a system of measurement in place. You need to be able to measure. You're being given money from investors to invest and create impact. You will need to report, just like you will need to report the financial outcomes and the financial returns, you will need to report what are the results, what are the outcomes that you manage with those investments, right? So this is our own approach. We have an approach that is based on what are the attributes and what is your approach to investment, and this is how we classify impact investment. Maybe going forward, then why is it that impact investment is such a big thing now, right? And there are many things that are in fashion. We believe this is not a fashion, this is a trend. And maybe I would take a time here and I think put it philosophically, right? So philosophically, we are in a world where many of the social contracts that we have are evolving, right? So who's looking at the elderly? It's changing. Who's looking because couples in general across the world, they both the man and the woman or the 2 people in the house work. Okay, this is overall in society. So this is changing. People are not working for the same company all their lives as they probably used to do before, not necessarily. Companies are also not having, they're much more flexible approach to employment. Women are actually joining the workforce, which is a great trend. And this is changing the social contract. So that, together with the fact that in the current world, I think we've come to the realization that the private sector has a big role to play in addressing some of the problems, and that there are limits to what the governments can do, right? There are fiscal limitations, there are organizational limitations, there are delivery limitations. So I think the realization of all of these things together has meant that the time for impact investment is now. So, the impact investment is something that can help us address some of the sustainable development goals and many of the things that we need to do about climate change. There is a lot more awareness for social and environmental causes. I think there's a survey that I saw, 65%, I think 67% of people that are in between 25 and 35 and that are going to inherit money, they want their investments to reflect their values. Okay, and if you look what are the values of the millennials, you will see that explains a lot of this drive towards impact investment. And I think the other piece is that it has grown out of a boutique approach to a really larger mainstream, large ticket approach to impact investment. So those things have been driving, and I think this is the time for impact investment. How big is the market, right? So again, if we are defining it by approach, right? So we are defining it not by, this is probably, there are many definitions about this. This is the way we look at it. We think that essentially there are around 636 billion that are measured impact, right? So there are $636 billion where there is a measurement system in place. This is of 2020, a survey that we did. In between the private markets and public markets. Of course, there's always a tendency to have a higher amount in the public markets because people like liquidity. But there are 640 billion, 636 that have a measurement system in place, right? There is another 1.7 trillion that is managed by entities that have an intent to have impact, right? They might or may not have a measurement system in place, but there's another 1.7 trillion that have the intent and the intention to have impact. So that takes us to a total around 2.3 trillion that we believe it could be considered the current market for impact investments. Right? We're talking about a sizable chunk of the market under the broad definition of the approach. Right? What is the potential size? I mean, one sort of approach to it is you could look at it based on what is the appetite, right? And this is based on a series of analysis that were done. We believe that number is probably roughly around I would say 21 trillion here, and what you would see is on the blue bar is those seeking commercial returns, okay, and those seeking, and in the orange one, those that are willing to have impact, having a sub-commercial return, below market return. And as you can see, most of us want to have a commercial return, right? And this is the investment marketplace. But there is a sizable chunk, in excess of 20 trillion, that are willing to have, they would like to have, to achieve both the impact and the commercial return. And I think this is sort of, the aspiration and the volume that we see. I guess the question is there really such thing as market returns in impact investment, right? Is there really, or even, can I even get better returns than that? And I think, there are many different approaches, but here, let me share our own portfolio, okay? So we at IFC, we invest equity and debt, another product, mezzanine, and other things. We looked at our own equity investment. So if we assume that we are an impact investor, and we have the intention to have impact, and we have measurement system in place, how does our portfolio look? Right? We looked at it. This was an exercise as of June 30th, 2019. That at the end of our fiscal year, and we compare ourselves against public equivalent, public market equivalent. Right? So we compare ourselves against the Standard & Poor's 500, right, since 1961, and yes, we outperformed them. We compared ourselves to the MSCI World, right, since 1970 to make it comparable, and yes, we outperformed them, right? And then we compare ourselves what we believe is probably the best proxy for our investment, which is the MSCI Emerging Markets, because we work only in emerging markets, and yes, our portfolio of impact, what we call impact investments, actually outperformed the MSCI markets in 1.3 times, right? So I think based on our experience and in the trust that I think as an institution we have built with society, we believe that there is no discussion that impact investment you can actually get at least public market equivalence, if not better, right? This is sort of our view. This is almost a dogmatic approach that we have based on data, not because we believe, but because we looked at the data and it's a fact. Okay? So this is sort of the background. What have been the bottlenecks to grow? Right? Is historically over the past years as impact investment takes off. What we just discussed, to establish that impact investments can actually offer commercial returns. I think yes, we are here. We are almost like preaching about this, and there is an advocacy work around it. But there are questions, and it's a fair question, but that we can only respond with data. I think there is an increased need to have transparency and discipline on how investments are managed to achieve impact. Right? I think I'm giving my money to an asset manager. I want to know how this firm invests my money, and I also want to know how they actually achieve this impact. It's a dual reporting, I think, not more. I think there are regulatory barriers, different across markets, right? So some markets this is being regulated, in some markets it's not. And I think impact management and measurement it's a big thing. Right? I think the challenge with impact management and with impact measurement is that it has to be statistically significant, it has to be transparent, it has to be cost effective. Those of you that have worked in the development field will see that sometimes the evaluation of a project is actually more expensive than the project itself. I mean, if you don't take control, so we need to have a good cost-effective approach that gives us the right sort of measurement of the impact that we have. So these are sort of industry challenges that I think we jointly as an industry we will need to address, and it is an evolving field. We as IFC got together with another series of institutions. I think it's around 42 institutions that we got together to put together the operating principles for impact management, which are essentially it's a set of principles to define what impact management or impact investment is, right? Because what we didn't want to happen is that all of a sudden, if you call everything impact investment, then nothing is impact investment, right? So we have a previous experience as IFC where we put together environmental and social principles that then were adopted by banks as equator principles. And based on that experience, we put forward, we got together with others, and we put together these operating principles for impact management, which today are separately managed. So it's a separate managed working group that has that helps fund managers, asset managers, they voluntarily join, right? So this was launched, I think, 2.5 years ago. Today we have 150 signatories across 37 countries, around 430 billion in assets under management. And this has accelerated a lot during in the past year, the number of firms signing. Okay? So we believe this is a very successful and I think it will help us standardize the approach to impact investment, so that when we say impact investment, we all call the same thing impact investment. Couple of things that you probably are getting to this that probably makes sense. Why does impact investment make sense in India? Right? I think I don't need to tell you one of the biggest drivers is scale. Okay, so you can achieve large scale, you can achieve problems, you can help support problems in large scale in a country like India. Looking at this figure, India received more than 2.6 billion in impact investment in 2020. It's coming down from the previous year, but we expect that this year will actually be higher. As Ashu was mentioning, financial, agriculture, and education take the lion's share of this, but there is an upward trend, even though it here looks down. Actually, there is an upward trend for, I think, technology and healthcare. Right? I think the biggest opportunity here is that there is a big financing gap in India and in many other emerging markets where the private sector can step in and have good returns and have good impact. Right? I think this is the trying to oversimplify a situation, and I think because of the level and the depth of the problems that we're facing and trying to solve all together in India, of course there will continue to be opportunities. Right? There are many challenges, and I think one of the things that we have learned, this is coming less as more of as a development bank, to address these issues, we need evidence-based policies, right? So we need evidence, and I think impact investment is something that, we're getting to the point that we can say it's evidence-based. You can get returns and achieve the impact, and you need to work in partnerships. And I think this is something that impact investors and impact and asset managers that engage in impact investment are very good at doing the right partnerships with the right institutions so they can achieve this impact. Couple of, I guess, policy or structural challenges that I think we believe will help us get to a better, for the market to take off, at the probably level that we think. There are issues around either you are an NGO or you are a fully for-profit company, but there's nothing in between. Some other markets have evolved in different ways. This brings some a high level of compliance and reporting costs if you are one or the other. I think this is not a problem that is unique to India, but we don't have a standardized way to measure impact, okay? And I'm not advocating here for more regulation. I'm just saying that, as an industry, or we don't have a generally agreed, this is how we measure impact. And then, this is an issue again. If I would remove the headline from here and it would call it almost the name of any other country, would be pretty much the same. It's their limited access to capital by this company. So the job of the firm doing the impact investment, you can do equity, but could you do debt? Sometimes it's very difficult to do that. You will see a lot of impact investment happening in the form of equity, but very much less happening in the form of debt for structural resources for the type of companies that you are investing or financing. And then there are always restrictions, or not restrictions, there are specific regulations around foreign investor participation in any country that could help you boost or could help you sort of tame a little bit of the inflow of impact investors into the country. And then, there are limited exit opportunities. So this is something that, when you go below the big companies or below the mid-sized companies, your job as an impact investor, that sort of a private equity oriented impact investor, gets tougher because there are not that many exits or ways to exit, right? Usually you would need to go to self-liquidating assets or some other stuff. You go after the cash flows or other types of structure to really get the returns and achieve the impact that you're seeking. Key takeaways. I'll stop here with this because this is terminology, and impact investment is evolving, right? So I don't want us to really lead to let's not get bogged down by this. I think measurement, blended finance, where you mix concessional or let's say donor money with for-profit money, this is an evolving field. I think we're every year and every time it's getting better, but we're in the middle of a field that is evolving. I think I really want to stress this. Profit and purpose are not mutually exclusive. I think we've shown our track record, and I think many of people probably attending this or in the market and will attest to this. Yeah, you can achieve both. All investments have both positive and negative impacts, right? This is something that we need to be clear. There are very few investments that only have positive impact. What we're looking for is the net positive, is the maximization of the net positive. And to know that, you need to measure. There is no other way around. When you don't keep score, then anybody can win on everything, or everything winning, and no one loses. So I don't think that's the case. I think you need to measure and try to maximize the net positive. The approach to impact investor or to impact investment is the intentionality and the ability to measure. This is what we're talking about, right? So you could be doing many different things. I know this is going to get narrowed down, I think, as we move over the years. But I think that the combination of the intentionality and the ability to measure and the seek for market returns while achieving that impact, I think that's what the type of impact investment that I think is going to take off. We believe that impact investment can help us address some of the market and even public sector failures that we have in the countries that we operate. We really believe that. We've seen it in different investments and in different sectors. We can talk about it more in the Q&A. Impact investment is an investment mindset, right? It's and based on the investment cycle, there is not a specific product. Once you have this mindset and this approach, I want to have the impact, I want to have the returns, and I want to have the intention, and I can measure it. You could do it by donating money. You could do it by donating and lending. You could do it by lending and investing equity. So the choice of product will, in a way, depend on the impact that you want to have. But the starting point is the mindset. So I'll stop there. Ready to talk if there is any question. Thank you very much. Over to you, Asha.
Thank you very much, Hector, for a very insightful presentation covering what IFC does, its investments in India, its engagement in India, and throwing light on impact investing in a lot of detail. I really liked what you said, which is impact investing is about a mindset. It's about seeing if that dollar can go that extra mile. And you brought it out very nicely, especially in terms of talking about how the different definitions are, but they are by and large the same. And the way you put it, that the only difference, if I may sort of paraphrase what you said, between impact investing and traditional investing is around that mindset. Here you look at that extra rather than only returns. And you did make a very fair point that in impact investing, it is about delivering market returns. It's not just about societal impact. And that, I think, is a growing realization, I would say, even amongst mainstream investors. And in the context of how every single country around the world has become very focused on their SDGs, I don't think any government by itself can deliver on the SDGs by 2030 without the participation of the private sector. And in that, impact investors are going to play a material role. Like you pointed out, nearly $2.6 trillion will be needed in emerging markets just to meet the 5 SDGs around climate change, education, health, roads, electricity, water, and sanitation. And in the context of India, the financing gap itself, looking out into 2030 in the context of meeting SDGs, is pretty large. It's 565 billion, like you pointed out. So whichever way you look at it, whether it is India or any other country, impact investors are going to play a material role in meeting SDGs. You made a very fair point around need for standardization, need for debottlenecking processes, having the right compliances, but probably cutting down bureaucracy, looking at better standards of measurement, and making sure that these were disseminated, disclosed more transparently, because that would go a long way, I would think, in impacting, in actually encouraging or crowding in more LPs. Like you put it in your summary slide, profit and impact are not mutually exclusive. They kind of go hand in hand. And we've received a lot of questions, and I had a lot of them as you were going through the presentation. So I'm going to start with what's top of mind for me, and I think for a lot of people. Have you seen any changes in the way institutions like IFC have operated, and specifically in the context of impact investing, given the pandemic?
Thanks, thanks, Asha. Yes, I mean, I think there are. I think there was of course, there was a moment of shock, at the beginning, and the realization of how big this was. But immediately after, I think many institutions like ourselves had to redirect. Okay, so I think one big one is, how can I put it? I think there is an increased appreciation for the role that health care plays in our society that has driven more investments in that area, right? So in pursuit of, addressing market needs or addressing a growing market need. So we have seen a sort of an uptick in it takes a while, but the interest and the amounts of money that are invested in healthcare, in the impact space, are being much higher. I think that's one. I think the second one is the pandemic has accelerated the adoption of digital, right? So digital first option. Talking to our team, we think it's at least 1 decade, that has been sort of accelerated the development of many of these. I also think that education, it's another sector that has, particularly because those of us that have children, and those of us that are studying or anything, we've suffered because of this. The search for additional sources of complementary education has also been, how do you rethinking the model of education and investing there. So I think health, education are two sectors that in my view have seen a response. I think we as an institution have to, you need to rethink everything. And I think in many of our portfolios of investment, I think we will need to be more patient, right? Because it's essentially 2 or 3 years lost in some industries, right? Maybe one in another, but some industries. But I would say health and education are the 2 sectors where I've seen the biggest change in how we address and the biggest inflows of money going into those sectors, in addition to technology cross-cutting, across industries.
So that, brings me to the other question, and you referred to it in your presentation around in terms of measuring impact, right? With everybody focused around digitalization, in your view, how can we leverage technology to cut down the costs of impact measurement? Or for that matter, just make it more efficient?
Okay, it's a tough question, huh? But I think emerging markets are showing the way. I'm gonna give you an example. Okay, before the pandemic, we as IFC, we go and analyze an investment. So we would do a due diligence and appraisal and stuff, right? And that meant traveling people across the globe, and that meant taking 2 weeks to go and visit the client sites and do all the environmental, social, financial. With the pandemic and no one being able to travel, we had to find a way, right? So the necessity is the mother of innovation. So we started surveying sites with drones. Okay, we started outsourcing or hiring people that otherwise we wouldn't have hired, probably, to help us do it, because there was a restriction in traveling. So I think the ability to get data, I think the thing that I see in terms of measurement is the ability to get data from the field, whatever the impact is, if it's agricultural, with via drones or via satellite, and to process that data and to use, in all sorts of, whether it's artificial intelligence or whether there's any, to actually get, I think the biggest thing that is happening is that instead of waiting 5 years to see how a project turned out to be, whether it was positive or negative, we now have the ability at a cost-effective way to get data along the life of the project to be able to correct course, right? So I think the cycle has shortened, and the cost of getting that data via technology has gone down. And I think that's the biggest thing. I don't think we are necessarily leveraging all of this yet, because it's a mindset. So we're used to very long cycle periods, so we need to reduce them. But we're in the process of getting there.
You're very right. That's actually been the experience of most institutions, that the pandemic has forced them to rethink their operating model, and hybrid models are going to be here to stay. And in a lot of ways, I believe it's going to be positive from an impact on environment, from a climate change perspective, because it just means everybody is going to burn that much less fuel, hopefully print that much less paper, and it's going to just make the world a cleaner place and the environment more habitable. That triggers a thought in my mind. Do you see ESG investing and impact investing being vastly different? Because as you know, ESG is that decadal theme, and almost every single investor embeds it now, or at least calls it out. So how are you seeing these two streams as different? You see them converging?
I think at the core, it's probably they all come from the same place, meaning we're trying to achieve market returns and to achieve finance and investments as a way to viabilize or to make feasible positive impact, right? I think so philosophically I see them, and I think probably there is an overlap in between the two. I think that we, our experience at IFC, we were sort of I won't say call us the gatekeepers, but we were one of the leading institutions engaged in environmental and social standards, right, for a long time. Primarily, it started as a risk management tool to manage our own investments, and it evolved to be something that we thought we could contribute so that other institutions could use. And I think, so in a way, I'm not going to tell you we were surprised, but also we've been carrying this flag for a long time, sometimes in a very solitary way, right? And then all of a sudden, fast forward 3 years, everything is ESG, right? Or a lot of it is ESG. So it's sort of hard to it's good, I think it's good that that's a conversation that we're having about ESG. I think the risk in ESG, as it is the risk in impact investment, is really that we have a common understanding of what we call ESG, right? I think it would be a disservice to the ESG agenda, to the environmental, social, and governance agenda, to lower the standards or to essentially call or do greenwashing. That's a word that is used, because I think it would end up diluting that agenda. That is a very important. Right? So I think there is. The way I see, I think one of the biggest challenges in the ESG and in impact investment is to hold ourselves as industry to a standard of what we call that. When we call something ESG or when we call something impact, is really we're talking about the same, so that on the other side the investor knows that actually it's an actual ESG, or that I think that's it's very much easier said than done. I think we have a big work ahead of us for that. I think every now and then you'll see some cases of ESG investing that you really wonder if that's ESG investing. I think we all have our moments. So yeah, but I think at the core, philosophically, we're talking about the same thing going in different ways, and there is an overlap.
Oh, thank you. Given IFC's long experience with India and the significant investments made in the impact space as well, would it be possible to share an example where the impact was high and the returns were good? You don't need to specify the returns, but I'm sure the audience would love to get an idea of what kind of investments have made that material dual kind of return or impact.
So maybe let me tell you. Okay, so let me look. There's, I think, one area is the renewable story. Okay, and I think it's one of those. We started in 2009 investing in some of the early players in renewables. Okay, we started by putting in equity and debt very early on, and then we also went on and advised the government to set up solar, sort of a renewable farm to renewable plants. So it was a really concerted approach. Today, we've invested around $500 million in renewables. 50% of the incremental capacity that India has built, it's built through companies that we support. So we believe it's a really successful, impactful story that has been profitable for us. And probably it has been a mixture of investing in equity and debt there. And this is something I want to maybe convey. I think there is a play to do impact investment by doing debt. Okay? I think it's not only an equity play, I think there is a debt play too. So I think there would be one. I think another one that I think, at least we expect that there would be is our portfolio of investments in sort of digital enabled companies that we believe are addressing specific sort of challenges in the market. So we've invested in EdTech, right? So we've invested in education technology, upgrade, Byju's. We believe they're addressing a specific issue and a specific challenge in the market, and time will tell, but we believe it's going to be a good investment, right? I think that also goes to one of the challenges in the Indian market, that the impact that these companies have, and these and many other companies, it's self-reported, right? So I think this is where we all need to be held up to very high standards, so that even if it's self-reported, we all can translate that impact into investment. I think our investments in the either in financial services have also been like this. I want to say, non-banking financial companies that are targeting specific needs of households and housing have very high impact, and it has been successful cases. So I actually believe that in India, in a way, it's almost like it's the Disney world of impact investment. You can find many opportunities that have the scale and we have the profitability to go after. This is something that for me is very characteristic when I compare it with other markets that I've been involved or worked in. It is ground zero for impact investment.
No, it's great. I love the way you articulated it in the context of Disney World. So taking that itself, Disney has been continuously reinventing and evolving, right, with the changing preferences of its customer base. Given everything that we see around us, and with your immense experience across different markets, are there some changes, recommendations that you would have for the India impact investing landscape?
I think, it would be very kind of, I think to a certain point, I'm still new to the region. So I think, look, I think we need to, how can I put it? It all comes back to the same. I think there are a lot of opportunities. I think the biggest challenge that we have as industry, and I want to say this, it's a joint. We need to co-create this. Okay, it's to take the the impact investment industry in India to a point that it becomes mainstream, and where there is no question that market returns are compatible with the impact. Right? I think if you would do a random survey, a lot of people would still be skeptical. Right? How can you really achieve that? So I think that's the task that we as industry have, because that will allow us to mobilize that money that we, both domestic and foreign, that then we will be this addition, will help us close the financing gap that we see in India to achieve and to take India to the next level, right? So I think that's one of those challenges that they look beautiful and they look easy on PowerPoint, but to do it, it will really take you a decade, right, at least.
Yeah. So I come to my final question, and it's just taking a different lens on closing the gap, right? In a lot of ways, growing the GDP faster than it does today contributes immensely to closing any gap whatsoever. And there is enough research around the world that says that if you focus on women and you put more capital, debt equity, the impact on GDP is transformational. Studies have actually said that GDP could grow 35% above its average if you close the gender gap. Or, I've seen some reports on India say that $770 billion could be added to Indian GDP in 2025. And I know IFC's report itself says that if you can improve the flow of credit to women, India GDP would improve by 1.6%. So how do you see gender smart investing and impact investing? Because I really think that ESG, impact investing, gender smart are really all part of the same family, but your view would be really, really helpful.
So I'm so happy that you mentioned this, because I should have, and I did not mention. I think when you look within impact investment, I think gender investing is probably one of the biggest payoffs. I think for two reasons. I think because of the impact that it will have. So essentially, if you look at the world in general, and I think it's particularly acute in South Asia and in India, we are an engine that is working with only one, 1.5 or maximum sort of it is working, right? With women not incorporated into the workforce and not exploring that potential, we are always leaving money on the table. Right? So I think the impact of incorporating women into the sort of the workforce and stuff, it's immense, right? I think that's one piece. No one would debate that. But when you couple that with the fact that most studies and most literature, and this is again evidence-based, will show you that women-led enterprises are actually more profitable, have a better risk profile, have a better sort of scoring across any ESG category, right? That you get more revenue per dollar invested with women, and these are all facts. When we're women at the leadership, I see that the case to invest in two types of business generally, in women-led enterprises and in businesses that somehow enable the participation of women in the workplace. Right? In our case, we have a big engagement on through the financial sector on financing women-led enterprises. Right? We have a big push to invest in women-led investment firms. This is another area where women are underrepresented, particularly at the leadership sort of level. So I think it's an unbeatable case, okay, in terms of development, but also in terms of returns. Right? So in my view, probably it's together with climate and gender are the two biggest drivers in my view of this, right? And that also takes you to have to think about other businesses that probably do not exist today. So for instance, in Brazil, we put together as an investment opportunity for the private sector to invest in daycare, right? Because if you don't have the daycare, then how are you gonna allow many women to work, right? Or men and women, but mostly women because of the dynamics. But there was a business that did not exist before, right? And now it exists as a private sector, and it's profitable and it has an impact. So I think there will be some businesses that we need to think about. We need to be very creative. But yeah, it's an unbeatable, and I expect it, and it is, and I expect it to be a big driver of impact investment in India.
Thank you, Hector. We've come up on time. In fact, we're over by a minute. Thank you for your insights, your suggestions, and also the fantastic responses you had to my questions and those from the audience. Thank you once again, and I hand back to Monica. Thank you.
Thank you.